Welcome to our quarterly webinar. Today, Adam will provide an economic and investment update, and then Andy will delve into our investment process and address a current challenge pertaining to SCORE, which is our stock selection process. Boiled down to its essence, SCORE is a persistence modeling process that emphasizes fundamental attractiveness. Historically, SCORE performs well during risk-neutral and risk-off market phases, but inverts during risk-on periods. We're in the midst of an extended risk-on period, which Andy will discuss. Another recent challenge was the market's sudden sell-off late last year and subsequent recovery. While a normal market occurrence, it was odd how quietly this event played out. Why it didn't trigger more of a panic response remains a mystery, but we should psychologically prepare for more such episodes. And now Adam will address his section.
Thanks, Lowell. It's customary during our typical quarterly review webinars, the first thing we're going to do is just take a look globally across various asset classes and look at their performance from the beginning of January and through the end of the March. So as we just saw on that V-shaped chart showing the return of the S&P 500 through the last quarter of the year and its subsequent recovery, here we're really capturing most of that recovery phase. And we've got the stock asset classes grouped together on the left-hand side. And so this is broken out geographically with the U.S. domestic markets up 14%, international developed and emerging markets up just about roughly 10%, and then global real estate, which captures the real estate market domestically and overseas, was up 14%. So unlike what we've seen in the past several quarters with a lot of dispersion across these subcategories, it was a pretty concentrated run-up for the first 3 months of the year. And so while this is happening, we also have on the right the fixed income markets that have held up pretty steadily and stably, despite questions and concerns around interest rate hikes and the timing of interest rate hikes. You have a bond market that's been fairly resilient, which is a positive. And so as always here at the bottom, we've got the longer term trends on a quarter by quarter basis, so you can see some of what the best and the worst quarter performance has been for each of the categories. Obviously, a lot of volatility up and down on the stock side, more stability on the bond side. But and this has gone back since January of 2001. On average, you've seen some stable low single digit returns with variance in between. So what we'll do now is get behind really the backdrop of these numbers on the economic front and what drove most of those returns. So this chart up here is just taking what was on the last slide and transposing it in aggregate over the quarter. This is the trajectory of the global equity markets through the first 3 months of the year. And it's important to put into context some of what we were seeing and hearing coming out at the end of last year into this year. You heard buzzwords and buzz phrases like crash, recession, bear market, the next crisis. After a period of relative calm and stability leading up to that point, investors were jumping on the daily flow, the news flow, and trying to make a case to react to it. But as we stated at the beginning of the year, and what is still the case now, we've got a very strong economic backdrop despite these concerns. A couple of points I want to hit on. Number one, we've got low inflation, even with the strong labor market. So some of the year over year, this year versus last year comparison in terms of core and headline inflation are coming in right around 2%. So that causes really no major level of concern. Again, coupled with a strong job market, normally when you hit recessionary periods or a run up to them, inflation starts to become a big concern. And the Federal Reserve has made a lot of comments on this, which is my second point. So we've gone through a series of interest rate hikes over the past several years. And when the Fed does that, they're always trying to stick a soft landing. They never want to be too aggressive in either direction as to push us into a recession or to slow things down or to speed things up too aggressively. So they're stuck in a neutral point now, in an interesting spot, because the economy, which in July will be 11 years into its growth cycle, is, even if things have slowed a little bit, still progressing nicely with low inflation, with a good labor market. So there's no planned rate hikes now, except for one that is, in their dot plot where they make projections on when they think rates should be pushed upwards. There's one projected for 2020 and none for the rest of this year. So they're in this position where if they raise rates too quickly, they're going to risk slowing down an economy that's really not overheated at this point. And if they cut rates just to try to boost growth or keep growth going a little bit more, then that's psychologically going to send a signal potentially to the markets where, does the Fed know something about a recession that we don't, because the numbers wouldn't support it. So their strongest position is essentially to stay put, which is what they're doing. And lastly, on the economy, you'll hear a lot now, especially since we're in the midst of earnings season, about a slowdown in corporate profits, a slowdown in top line revenue. But it's very important to put that into context. Coming out of 2018, which was a gangbusters year for the corporate environment, a lot of that fueled by the tax cuts, a lot of that fueled by activity, still boosted by low interest rates. But we're benchmarking at this point this year's numbers to last year's, and it's completely healthy to see a slowdown or a slight decline on what we've been coming off of, because 2018 was as strong as it really is. So slow growth is completely acceptable. It's nothing to be nothing that's going to sound an alarm bell, especially in the context of all the numbers in aggregate. And the last thing on the economic front and on the headline side of things, there was a lot of commentary and discussion around the yield curve inversion, and I want to explain what that is and really what we've seen from start to finish in terms of what happens. So when you talk about a yield curve inversion, what happens is, in a normal case, you want to see, or you typically see, longer term yields over and above, there's a spread over and above short term yields. So investors need to be compensated for taking risk of buying longer term instruments by way of a higher yield. So when they say the yield curve has inverted, it means that some lesser term or shorter term debt instrument is now paying a higher yield than a longer term debt instrument, and that has historically been discussed of as a indicator of a recession. And so the best way to do this, or our opinion on the healthiest way to describe this, is looking at the 10-year Treasury yield compared to the 3-month Treasury yield. And so this chart here goes back to 2000, and it shows the spread, the 10-year Treasury yield minus the 3-year yield over this 19-year period. And you can see that we just tapped that line in terms of 3-month Treasuries, yields being over and above the 10-year. It didn't even hit 0.1%, and it only did it for 7 days before it bounced back. So I think a lot of the investment community, especially those that are bearish, have been waiting for something like this to happen to sound the alarm bell. But this is something that has to be sustained, and it has to continue for it to be any reliable indicator. So we had a little bit of a bounce, and it happened, but all things considered, I don't think it quite warrants the concern, and a lot of, at least what our clients have been hearing and seeing in the news. And then lastly, longer term, and we looked at this during our last quarterly webinar, we're looking at the same set of asset classes that we did on the first slide, but we're doing it over a 1, 5, and a 10-year period. So you can see on the 1 year, we've got some red capturing a lot of the activity from the end of 2018 and the second half of 2018. But this helps you understand some of the trends of what's occurred over the last decade in terms of asset classes. Two things I want to point out. Number one, you've had a really stable, healthy bond market from start to finish, even with low yields and then with rising yields. And then the second thing is the spread of returns between the U.S. equity markets and the rest of the world. So last 10 years, the U.S. market has essentially done almost double of what international developed and emerging markets have done. So something to just keep an eye on in terms of the cyclicality of markets and just what are some of the trends that have been transpiring over the last decade coming out of the financial crisis. And lastly, before we move on to Andy, another duplicate chart of what we shared during our last call, but I think it's a great source of positive reinforcement. This is a ranking, a year-by-year ranking over the last 10 years for all of the different asset classes or the major asset classes that you will typically see in a diversified portfolio. So you've got domestic large cap, mid cap, small cap stocks, international stocks, commodities, inflation protected bonds, and cash. And it's just ranking year by year, the best performer down to the worst performer. And then on the far right hand side, it's aggregating that in terms of the full 10-year period. So what you see here is what we typically see. I mean, you see 2018, what we came out of in terms of negative numbers, but you see the asset classes that really pay the premium, with small cap leading the way over the trailing 10 years. So our portfolios, Andy will outline, we keep exposure to large cap and small cap equities, and you've seen a little bit of a lag over the last handful of years in the small cap space, but we do absolutely still believe that long-term investors are rewarded by way of a small cap premium. So that's just a high level of summary of what's been happening through the quarter, what's been happening over the past several years in terms of asset class returns in the economy. And that's a good segue into Andy getting into our strategy, what we've seen on in our portfolio, and what changes are coming our way.
All right, great. Thank you, Adam. So that was our update on world asset class returns, as well as some macroeconomic items. But I wanted to focus in now a little bit more close to home on our strategy, which we call the size and style responsive U.S. equity strategy. So I wanted to start out by showing what Q1 of 2019 looked like from a size and style segment. So it was a good quarter overall across all segments. Every single size and style segment we look at was up over 10%. So if you were invested really anywhere in the U.S. stock market, I think you had pretty good returns. More specifically, we saw large growth and mid-growth stocks hold a relative edge over their value peers. That relationship did not hold true over in the small cap space that saw value stocks outperform growth stocks by a little bit, but overall, none of these differences are overly material. We saw earlier that chart of the S&P 500 being back basically to all-time highs. So I think clients who were able to stick it out and stay invested were really rewarded in Q1. Large growth stocks are actually already setting new highs compared to where they were last September. And large value companies are just 3% away. But I think sometimes when we look at stock returns, we focus too much on the large cap universe. The small cap universe still has a way to go to get back to even. So small cap growth and value actually are both more than 10 percentage points away from their all-time highs. So while we've seen a great bounce back in this quarter, there's still some room to grow down on the smaller cap side. Now, if you've sat in on one of these webinars before, or looked at our website, or even attended any of our seminars that we've done throughout the years, you've seen this chart before. And the reason we like to show it is it's a good illustration of the dynamic our strategy aims to exploit. Month to month or quarter to quarter, when you look at value versus growth stocks, it kind of looks like chaos. But it's actually quite remarkable when you roll this out over a longer time frame, in this case 1 year, just how patterned and cyclical the dynamics look. So we've shown this before. I think I might try to rebrand this slide as the wave chart. And basically, as the wave grows and it gets to its crest, that's a pro-value phase. But they don't last forever. And as the wave crashes back down and goes back below the 0% line, we're in a pro-growth phase. So over the past couple years, we've been tilted towards growth. But as you can see, that wave is beginning to build again, right? So we're beginning to see more and more momentum pick up on the pro value side. So if you've paid any attention to your transactions over the last quarter, you've probably seen us add more value names to your portfolio. That is in response to this trend right here, and it's something you can probably continue to see or expect to see over the next quarters and year. We can do the same chart when it comes to size. In some ways, this size cycling has been even more dramatic, and it tends to last a little bit longer. So historically, when you roll returns over, in this case, 36-month rolling timeframes, you see quite a pattern. Now, what's different here is recently the wave has sort of lost momentum and stopped altogether over the last 10 to 15 years. So the question that we have is, has the historical pattern stopped? And if so, what could be some potential explanations for why? In the early 90s, academics like Fama, French, and Sharp were just discovering and writing papers on size and style premiums. That is, they were finding that small cap stocks held a long-term return edge over large cap stocks, and same thing for value over growth. In fact, there was a paper written by William Sharp around this time frame that led us to launch our size and style responsive strategy. And then more recently in the 2000s, we've seen fund companies begin to take advantage of this research. So it took some time, and while we were launching our strategy to exploit size and style, others were too. You might have heard the phrase smart beta before, or maybe factor-based investing, but basically the trend has been for funds, both passive and active, both mutual funds and ETFs, to start to tilt their portfolios towards value, towards small cap, and towards other premiums that have been discovered by the academics. So while it took a while for practitioners to build strategies around the research, once they started doing that, we've seen the end of the cycling dynamic, or at least we've seen it moderate quite a bit. Now, we don't want to jump to any firm conclusions here because this is correlational data, and of course, correlation does not imply causation, but it does lead to some questions. Has the historical cycle just stopped altogether? Perhaps this 36-month time frame, which looking back historically was the best time frame to see a pattern, perhaps that is not the right time frame anymore to look at this dynamic. Maybe the trend has sped up. And it leads us to question whether a size premium even still exists. So I want to differentiate here between an anomaly and a premium. So when an anomaly is discovered in the market, one of two things can happen. Either that anomaly can be arbitraged away by market participants, right? This is the whole idea of an efficient market that modern day financial theory is based upon. Or that an anomaly can stay consistent and persistent and become a premium. So for a premium to persist, there has to be a reason for it. And that reason can be a few things. It could be that the time frame is important. Maybe only long-term investors, can access the premium. Perhaps it's liquidity. Perhaps there's behavioral reasons for it. In fact, the value premium today is still proven to be empirically strong. And there's a couple reasons for it. One, typically a long time horizon is required to take advantage of it. And two, simply behaviorally, it can be hard to hold value companies. These are the companies that are beaten down. They're not the darlings of the day. They're not Google. They're not Netflix. They're not Tesla. They might look more like IBM. Which one would you rather invest in, right? But over the long term, those more boring value companies have actually been the ones that outperform. But for investors, that's a very behaviorally tough thing to take advantage of. So does the size premium still exist? Dimensional Funds is a large asset manager. They develop mutual funds, and in fact, we do invest in some of their funds, especially in the international and fixed income space. And they urge caution over calling the small cap premium dead. They point out that the size premium is negative. Large caps outperform small caps over 10-year time periods about 25% of the time. And we know that 25% of events happen routinely. We just saw it in 2016. Nate Silver of 538, his model gave President Trump a 25% chance of winning that election. So we know these happen. Their advice, don't overreact to short-termism. It's so easy to fall prey to the recency bias, but in the scale of financial history, 10 years is a short time. It's not time to write off the small cap premium. AQR is another large asset manager with a strong research culture, and for them, they would probably take issue with the word still in the original question on the top of this slide. They released some research last year that showed the initial data and methods that showed that small cap premium in the early 90s may have been flawed and biased towards small caps. And using more modern methods and data, there may never have been a small cap premium at all. What they discovered is perhaps the small cap premium is completely explained by market beta. Small caps tend to be a little bit riskier, so they react more to the market overall, but it's not necessarily its own premium. So the truth is, we really don't know the answer to this question. There's smart people on both sides of the argument. What I do know is it will be fascinating to watch how this dynamic plays out going forward. But for now, as far as we're concerned with our strategy, we're going to maintain a neutral weighting to size. But we're going to explore other time frames to see if there is a shorter cyclical element these days. And we will take advantage if we see momentum go one way or the other. Illustrating this point, last quarter, we did shift away from growth over to value. This shows our old allocations and our new ones across the size and sell universe. So we're coming off our growth bet over the last 2 years to focus on value names. And as we mentioned, that wave is building. And if that momentum does continue, we're going to continue moving in that direction. As you can see, we are more heavily invested in large caps than small caps. And this is because the market capitalization of the stock market is weighted about 75% towards large caps, the remaining 25% made up of mid and small cap stocks. So for us, when we say we're neutral to size, we're 75% large, 25% small and mid. One question we've been getting quite a bit here recently, and it's a good question, has been around performance. And certainly performance over the last 2 to 3 years is not as strong as we'd like it to be. What I wanted to show here is our score effectiveness. Score, of course, is our stock selection model, and we build new models every 6 months. Now, as you can see, the last 4 models have seen inverted performance. This means that the stocks that we want to buy, that our model suggests buying, have actually underperformed the stocks that our model suggests avoiding. This is nothing new. In fact, we've seen it before. I've highlighted 2011 here on this chart, and you can see that was the last time we had 4 consecutive inverted periods. As Lowell mentioned earlier, this is what happens when the market shifts risk on, and factors historically associated with long-term excess returns aren't working. Typically, this happens following a bear market, as the low-quality stocks that were beaten down the most, they recover the strongest. But that's not necessarily the case this time. There wasn't a big bear market. Now, certainly, there has been volatility, and periodic corrections are normal. Usually, that's not enough to spark this type of risk-on environment. What we know is this won't last forever, as trends in the market tend to revert back to their historical norms. And we've seen some positive signs, maybe some initial signs of some positive momentum over the end of 2018 and maybe a little bit into 2019 as well. But right now, as long as we maintain this risk-on environment, stock selection will be a bit of a headwind. So what does it mean when we say risk-on? What does it look like to be in a risk-on time period? So our model looks for qualities and companies that are associated with long-term returns. That's what persistence-based modeling means. And these factors are high quality, profitable companies with attractive valuations. These are the sound investments that we want to invest in. But what we're seeing right now is the lower quality end of the spectrum, those companies that are exhibiting low to negative profitability, expensive companies. These are the companies that are outperforming right now. And we just don't believe it would be sound to invest in these companies. So while these periods of underperformance are frustrating, for us, we need to maintain patience. And in fact, we're not the only ones finding this issue. So O'Shaughnessy Asset Management is another large asset management firm with a quantitative process. And their CEO in their most recent quarterly letter pointed out that for them, there's 6 factor themes, which are things like profitability, momentum, value, that their least favorable decile outperformed the most favorable decile. So for anyone who's using a quantitative process, anything that's remotely persistence-based is finding it to be a difficult period. And what we know for active managers, no one likes it, but underperformance happens. No one's right 100% of the time. In fact, there was an AAII study that found that 85% of top investment managers underperformed their benchmark for 3 consecutive years. We know that underperformance happens, but the thing that locks in underperformance is changing investment strategies at that time. This is the basis of the behavior gap. Performance chasing is one of the biggest culprits. The behavior gap simply is investment returns investors should have received and investor returns that they actually received. And Dalbar, Morningstar, and Vanguard have over and over and over found that this behavior gap exists. They find that investors underperform benchmarks because they made changes to their strategies. So the way to overcome the behavior gap is to pick a sound investment strategy. There's plenty of sound investment strategies, whether that's an active manager or a passive product, but that's actually the easy part. The hard part is sticking with that strategy. It sounds like easy advice, it's easy to say, but it's kind of like diet and exercise. Much more difficult to actually achieve. So I wanted to focus in on what we're doing now to address this. So I wanted to start by actually saying what we're not doing. And what we're not doing is changing our core beliefs. We believe that value, quality, and profitable companies should outperform over the long term. And we're going to continue choosing stocks that have factors correlated with long-term returns. Our size and style strategy will proceed as normal. We know that the style dynamic still seems patterned. Right now, we're neutral with regards to size. But as I mentioned, if we see momentum in shorter time frames out of the size factor, we will continue tilting portfolios the appropriate direction. And perhaps the most important thing is our buy and sell discipline. We're going to continue adding stocks that are buyable per our model, and we're going to sell stocks when the rating falls or when short-term momentum suggests we should. And in fact, the sell discipline is even more important than the buy discipline. It's important because both professional and retail investors fall prey to the same behavioral biases. It's hard to sell an investment when it has gone down. However, we know from the behavioral research, investors get risk-seeking with losses. If you've ever tried to hold on to a stock until it gets back to break even, you've experienced this. And that tendency can be destructive to returns. So we've created a framework around ourselves that helps us overcome this bias that we know we have. And the sell discipline, cutting our losses when we should and replacing them with something better is a powerful part. So I also wanted to address what we are doing. So we are adopting and investing in technology. We've actually invested in quite a bit of technology over the last few years here. Trading tools have been able to increase the efficiency and speed in making portfolio adjustments. And perhaps the thing I'm most excited about is our portfolio optimizer. This is a sizable investment, but we're building 40 stock portfolios. And while that is enough stocks to diversify away the company-specific risk, that risk that is not rewarded by the market, it's so easy for a human portfolio manager to unwittingly take on risk factors that they don't even realize. So the optimizer controls for these known risk factors and builds portfolios that more precisely hit our size and style targets. We've been using this optimization software for a little bit more than a year, and we found both in back tests and in real time, we've been more able to accurately achieve the returns available based on our size and style factors. And for longtime clients, you know that we've long been focused on research, and that's going to continue. In fact, we're investigating right now, why are we in this risk-on market? There's some interesting threads that we're chasing down, and certainly as we learn information, we will share it both in these webinars and on our blog. And then I wanted to leave us with something that's a little bit more actionable. So it is possible to do our size and style strategy using other investment vehicles, specifically size and style corner ETFs. Now, when we say ETFs, we're not talking about just investing in the S&P 500 ETF and calling it a day. We can still run our size and style strategy and tilt your portfolio towards the size and style phase that's in favor using ETFs. So while this might give up an opportunity to achieve alpha from stock selection, it also reduces tracking error. If you're a tracking error tolerance, if tracking error is something that impacts you, this might be something that sounds attractive. I encourage you to talk to your advisor about the possibility of adding ETFs and incorporating something we call a core satellite approach to building your portfolio. So we'd like to thank you for attending our webinar. If you have any questions, please feel free to send us an email or call your advisor. We'd be more than happy to answer. But before I leave, do we have any other thoughts?
No, only other comment, Andy, would be that this webinar is also being recorded, and we'll make sure to post on our client portals and through our distribution email list the audio and the video recording. So if after reviewing this you have any other questions or any other significant comments, please absolutely reach out to us or your advisor, and we're happy to address everything from there. So thanks everyone for attending,